Welcome back to Trading Hour. Well, George Thomas from Quantum AMC joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, George. First up, what are you making of the earnings season so far, especially given the fact that you've now had a couple of large capital goods companies like L&T go ahead and deliver their earnings? So how are you looking at that space particularly?
So from a capital goods perspective, from an earnings standpoint, it looks reasonably okay in terms of the order book growth or execution. If we look at it, it has been in line with expectations. So there is not much, nothing much from an earnings perspective. But the clear problem is with respect to valuations, where it remained elevated across most of the space. So even with the recent market correction, if we look at the broader market level, so at least if I consider the top 750 odd names, which has recent market caps, decent market caps, if I look at it, the correction has not been material enough for us to trigger a new addition. So if I look at almost 60% of the stocks have fallen by less than 30% from their recent highs. So considering the recent stellar rally, those have not been enough for us to make a new addition into any of those space.
George, on the whole, how has the earnings season been to your mind? What's the skew of upgrades, downgrades, and any firm trend that you've identified post the Q3 earnings, which you can incorporate it in your portfolio in terms of a strategy?
Clearly, there is some moderation in terms of consumption, and some part of it is due to high base. For sectors like real estate, where we have seen a stellar rally in the last 2-3 years, a lot of that earnings moderation is due to high base. So once we normalize, we don't see there is any clear thing to worry. But on so rather than speaking on a broad sectoral level, there has been selective opportunities. Like we have added some positions in some of the existing portfolio names into. So one of them is a rural-based two-wheeler company, and the other one is a gas transmission company where the demand visibility looks reasonably good, and they have a fairly good guaranteed return kind of model, where we feel the recent stock prices offer a decent amount of upside. But from a broader sector call, like I said initially, the valuations have not come off to a level where we could justify fresh additions which meets our threshold upside levels.
Understood that. And how are you looking at the banking and NBFC space? They've recovered quite significantly from the recent lows after the RBI liquidity infusion that has come in. But post that, what exactly has transpired? Do you like any of these stocks?
Yes. So some of our recent additions have been into private sector banks. So clearly, if you look at it, the system liquidity is improving. And our sense is, as those credit environment kind of normalizes, some of the better underwriters would stand out. And our sense is in the times to come, considering the levels at which they are currently trading, some of the private sector banks and large financials could lead the next leg of rally. Because considering that they are at fairly attractive levels and the environment is kind of normalizing. So even if you look at the broader macro perspective, even the private capex or even the infra development has not been at its best pace in the recent past. So as and when that normalization happened, we should see some ripple effect passing on to them. Plus, the credit environment is normalizing. All these would lead to some of the good underwriters standing out.
Understood that. And so within the BFSI space, what would be the order of preference? Or would you like private banks, PSU banks, or would you like the NBFCs? And within NBFCs, how would you rate vehicle financiers versus home financiers?
See, private sector banks is the obvious preference there for the reasons which I already stated. But within NBFCs, we have positions in certain select NBFCs which has good niche skills. One, it could be either a certain segment where they have good track record and ability to underwrite, where the masters may not have. Or it could be a cost of funding advantage because of better parentage and things. But some of the home financiers which have come up in the recent past, our sense is, their collection systems has little more room to streamline. And once, until that is verified, we would stay away from such names.
What about stocks like Zomato? Is it a buy at 220?
See, I don't want to give a stock-specific call, but obviously some of these new age business models where profitability has barely started showing up. So from a fundamental investor to justify these kind of valuations, you would have to factor cash flows far out into the future. And that is quite challenging. The valuation is a clear challenge there, where you would have to justify the current levels with cash flows which are far out in the future. And those are very sensitive to how a lot of assumptions move out. So some of the new age names where cash flows are kind of back-ended, we would currently stay away from them at these levels.
Understood that. Now, within the materials and mining space, how do you look at cement companies and how are you looking at the metal names?
See, both these sectors are at interesting juncture if you look at it. If you look at cement, the environment has not been great. The pricing environment has not been that conducive in the recent past. And our sense is from the kind of consolidation which the sector has gone through, it could be just a matter of time before the pricing power comes in. And at that point in time, we would see the profitability levels inching up, because clearly, if we look at certain regions, the current profitability levels does not justify any incremental investment, and therefore that itself would give a natural push to pricing over the medium term. And therefore, we are quite positive in some of those regional names. So coming to the metal names, globally, if you look at metals, the capacity additions have been quite minimal. And the largest economy, China, they have very clear goals in terms of emission standards and their targets in terms of capacities in various metals. So some of the key metals could see reasonable support from the basis that the incremental capacity additions is limited. And therefore, pricing support should be a lot higher than what we would see, we have seen in the past cycles. So from that perspective, some of the metal names looks interesting. But of course, upside has to increase slightly from the current levels.
Thank you so much, George, for joining us and giving us a sense of how you're looking at markets, your fundamental picks, and your sectoral views. Well, some time ago, you saw a few flashes on your screen. This is regarding, definition of geographical areas as far as city gas distribution companies are concerned, and they have now been notified as common carrier areas. This will have significant implications for the incumbent CGDs, so names like Gujarat Gas, Mahanagar Gas and IGL will remain in focus. We'll await more details on this particular development. But time now for a short break. Management of Wellspun Living joins us next to discuss their Q3 numbers and more.